As trade tensions continue to heighten, many are asking what tariffs will mean for the economy. Well, UBS is one firm that thought tariff threats would never become a reality, but now they're changing their tune. In a note to investors, they say, we were wrong. These tariffs could be bad news for the global economy. Let's bring in UBS chief economist Seth Carpenter. Seth, great to have you with us.
Thank you very much. It's a pleasure to be here.
So I want to understand what you miscalculated here, and that is you thought the USTR would release the list but not escalate it. But they have escalated it to have the hearings, and you're looking for the implementation by September?
That's exactly right. So the first round of tariffs were placed on $50 billion worth of imports from China. But those $50 billion were carefully picked so that they would have very, very, very small effects on the U.S. economy. So it was an opening salvo. It was a very, very real move. It was meant to show, in our view, that the administration was serious, and we think they have been. But we saw that as the administration being extraordinarily careful in the way that they were implementing policy. We expected a release of a list of 200, but a list isn't a legal step. Instead, they also initiated a further investigation into Chinese trade practices, and that step is a very important legal step, which really sets in motion a whole series of actions that will ultimately lead in either tariffs on the one hand, or the president certifying that all of the complaints the U.S. has had with China are now resolved. And we think it almost certainly has to result in the tariffs.
Yeah, they have taken that step and yet just confirmed that there are no high-level trade talks going on with China. How concerning is that to you?
So it is somewhat concerning. On the other hand, when these sorts of high-level discussions go back and forth, you don't tend to read about the true discussions in the news. So there should be some staff-level discussions that are going on. I hope there are some staff-level discussions that are going on. And there is a path to de-escalation. There were trade negotiations going on before the first round of tariffs were imposed. And so if they can come back to that momentum, to those deals that they were in the process of trying to make and build on that, then there is a path to de-escalation. We just think that that path is fairly narrow.
But I guess it all depends on what the objective is by imposing these tariffs. And there are those who believe that the president, ultimately wants more production to come back to the United States. That doesn't happen overnight, so that could mean that the tariffs are in place for quite a long time. What do you think?
I completely agree with what you're saying. Our view is that the administration probably needs to be a bit more explicit about what their definition of success is. We have definitely heard from Trump over, not just since he's been president, but for many decades, his view on trade, and he feels very strongly about it. This is one area that we have consistently had the view that is not an area of policy that's just going to flip-flop willy-nilly because it's something that the administration cares about. So what the ultimate objective is, in our view, is some actual change in the benefits of trade, more of that accruing to the United States. We have to see precisely how that plays out.
So in terms of the impact, Seth, right now, escalation is not factored into any of your estimates for the U.S. economy. How do you take a look at what the impacts could be? Do you take a look at it in a very sort of strict way in the $250 billion of goods that are going to be subject to tariffs and the impact on the economy? Or would you go broader and say this will perhaps cast a pall over capital spending, or maybe there could be qualitative retaliation by China? What's sort of the worst case scenario? Markets like to discount worst case scenarios.
Well, so far the markets seem to be reasonably optimistic. Just at the top of this segment, there was you went through the equity prices and they seem to be holding up reasonably well. Our view is, yes, you absolutely have to take both a specific narrow direct view. Prices are going up on some goods, and as a result, demand for those goods will fall. And so there's a first round effect that seems reasonably straightforward. When it comes to the first round of tariffs, the tariffs on $50 billion, that seems like a fine way of analyzing the effect. But when the longer list that's been published, when we get to this $200 billion in potential Chinese imports subject to tariff, at the top end, there are some categories in that group where China is, if not the only source, is a predominant source of those inputs for the United States. And so if you think of those as intermediate goods, and some of them are inputs to manufacturing production, you could imagine then supply chain disruptions. And that's for us the part that we worry most about, that kind of nonlinear effect where it's not just somewhat higher prices causes somewhat lower spending.
No back of the envelope calculations as to impact yet, though.
So we published as a bank, the global research team at UBS, a few different scenarios. None of the scenarios that we published specifically had exactly the situation that we're in now, because we have not yet heard what the Chinese retaliation would be. But that note said if the U.S. imposes tariffs on another $200 billion of Chinese imports and imposes tariffs uniformly across all automobile imports and in reaction to U.S. imports on China, the Chinese government retaliates in exactly a symmetric way. That could be as much as 100 basis points of growth on the U.S. economy.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.